Good afternoon, everybody. Welcome to another edition of Pre-Market Prep at the close. Spencer Israel, Joel Elconin, joined now by our special guest today, Chris Temple, editor of the National Investor. Chris, thanks for joining us. And Joel, I want to just start us off here with what we've been doing. Give us a quick recap of what's happened here in the market today, because it's been I guess every day is a surprising day, but today more so, especially so.
Yeah, well, I don't know if there's a little stretch here, but kind of calming down here a little bit today, Spencer. We did have that dip off the open. Couldn't sniff that pre-market low at 22.75. That's only 10 points away from that low from yesterday. So, bulls, there's the line in the sand. Potential double bottom there at 22.65.75. Spirited rally. We were not able to take out the pre-market high, and I think the reason for that is, your average daily range is right up there near 200 points, and we got up there to 175, 185. So what I've been talking about is at least the market's calming down. Smaller average daily ranges. Wouldn't mind having a larger daily range to the upside, but here we go. Above 24.60, if we could pierce that, not much, folks. I'd call 2,500. Or, well, let's see here. Wednesday's Globex high was 24.86, but I think you're splitting hairs there. Maybe a peak at 2,500 if that happens. Also, traders, option traders. I want any kind of trader. I want to remind you, tomorrow is a quad witch. Normally, quad witch expirations are crazy. The spider goes ex dividend. I mean, you got all kinds of stuff going on tomorrow. So be careful. Just absolutely be careful here. Trading those options or whatever positions you have. Are they still going? I know they're not doing rebalancing, but are the spiders going ex dividend tomorrow? I'm pretty
I
sure
believe
they
so.
are.
I haven't heard
Yeah,
otherwise.
they go
Yeah.
every quarter. So that should keep in mind. Big help today in the market is the crude market. Crude's trading up 532 here at 26.15, just oversold beyond belief. So that's getting a little bit of a rebound. Also, you have gold up $5, 1483.10. Silver playing a little bit of catch up here. That's up 4%, but we just saw silver just beat up relative to the gold prices. And then silver, as I said, that's up. Bitcoin's rallying, folks, up $855 at 6,195. So kind of recoveries around the board. We still got 17 minutes left in the session. So anything can happen. But go ahead and Spencer, introduce our guest again.
Yeah. So Chris, why don't you, I guess really we should start off with how have you been approaching / dealing with the market these past couple weeks here? Because it went from pretty calm to pretty crazy in a matter of days.
Well, Spencer, I started doing this a little over 40 years ago, and then we had that double dip recession, double digit inflation, double digit interest rates, and all of that stuff back in the early 80s, and all of the episodes in between. But none of us alive today has ever dealt with the kind of thing we've seen in the last month, where you shave a third off of the valuation of the stock market in a month's time. Hopefully, we never see it again. And you've got a lot of moving parts of this. Joel mentioned the oil price, and I'll tell you, if it were not for this second black swan event of 2020, I'd be way more optimistic right now, thinking that, okay, we know we're going to have a recession. We know that things have been hit hard in the economy, but when we see the policy responses and things like that, okay, maybe we're trying to slug out at least a near-term bottom here right now. Probably not the final one, but at least the near-term one. The oil thing, which has been getting no attention and needs to, is a potentially debilitating thing in and of itself. We've all heard of the debt that the US-based shale companies have, how the collapse in the oil price has got all of them in trouble. Are they going to get bailed out or a lifeline? Are they not? We don't know. But thankfully, coming into this last month, you guys remember when I was on with you earlier in the year, one of my big themes being the odd couple, to be long gold and to be long treasuries at the same time. And the odd couple, because historically those things wouldn't be bullish together. You wouldn't see bond valuations go up at the same time as gold, but we did. The day that GDX and GDXJ, the two major ETFs, peaked, I told people to start selling them. We also got out of the Treasury ETFs, and the money that we locked up from those, thank God, because they both went down, especially gold got annihilated after that, gold stocks especially, pretty much mitigated, I'd say, about 2/3 of the losses that we have on a small part of the portfolio that's still in individual stocks that I stuck with. It didn't matter how good the companies are, they all got their brains kicked in, like everybody has seen. So, I think on a total portfolio basis for the year, we're probably down about 5.5 or 6% in this environment. I'll take that.
And so, Chris, we've been trying to identify themes. I was looking for themes every day. It's really hard, right? A number of defensive and utilities names are up in recent days. But the consistency is just not there. Today, Walmart is down, Kroger is up. Go figure. I don't know what that even means. So how do you sort of navigate this market right now when it's sort of impossible to find any themes?
Well, it is hard to find themes right now because things are so disjointed and they're not going to get fixed immediately. But my attitude is, and Mark Cuban made a really good point yesterday morning when he was interviewed on CNBC. He said, every day that I see, especially a big downdraft, if you get these days, the Dow's down 1,000, 1,500 points or whatever, he's heavy in cash. Take 1 or 1.5% of your portfolio on that day. Now, what he did was to buy a little bit into spiders, dollar cost average into that, hoping for the eventual rip higher we're going to get. We can put coronavirus in the rearview mirror at least. And I think he mentioned 1 or 2 names. And I've been kind of doing the same thing. I'm adding back a few old favorites of companies that we used to be in that I sold at higher prices and now they're cheap. I mean, look at AbbVie, great yield play. I don't think they're anywhere near the front of the line if they're going to be in danger of cutting their dividend like some will. And a theme that I'm really salivating over, Spencer, but it's going to take a while and you can't go whole hog anytime soon. You really need to look at your shopping list right now. Look at companies that, even if you've got still some downside risk near term, if this bottom that Joel suggested also we're trying to slug out here doesn't hold, it's nevertheless, you got a company that a year or two from now, you're going to be happy that you own it. And AbbVie is it. I told people last summer to get into AbbVie when it was at its low. I thought it was beaten up unduly. It worked well. We sold it at about $90 this morning. It was under 70. I told people to get back in. And I think in the future, because the bond market now has changed, the bull market for treasuries is over finally after 40 years. And now what you're going to see going forward is an upward pressure on treasury yields. But that, in a way, will be a good thing because as we get through this present period, start to reflate a little bit, and treasury yields are still going to be somewhat compressed, though not as low as they are now, investors are going to be looking for yield again. And the new income, the new safe, havens, so to speak, are going to be the bluest of the blue chip, good finances, dividend paying companies that don't have to cut in the next 6 or 8 months their dividends. So I'm starting already to put together a portfolio of income stocks. I had 3 companies on that list. Now I've got 11, and we'll be adding 1 or 2 more here and there.
So
we're on the line. Oh, I'm sorry, Spencer. Go ahead.
Go ahead, Joel. Go ahead.
We're on line with Chris Templeton of the National Investor, a veteran of the markets here. So let's put this, you've been in the markets for a long time. Let's put this crisis in historical terms. Both you and I just barely missed the Great Depression. We were certainly, I was very young during the oil crisis. You had the crash of 87. I was a very young trader on the floor at the Merck. Navigated LTCM. I wasn't trading my own money, so it was a little easier trading house money. You had the internet crisis where I was trading my own money, which was for me, which is a great prosperous time. Financial crisis, I kind of sat that one out, and here you are. Just all wrapped into one. Just put this in a historical perspective, looking back and also moving forward.
Well, you said the magical phrase there, all wrapped into one, because every possible thing that can happen except for locusts, we got compressed all in the few weeks period, and it's just the beginning. We don't know if a recession will become a depression. I think it's a safer bet day to day now that rather than the cyclical bear market, this is the beginning of a secular bear market for stocks that may go on for quite a while. Even if we've already seen the majority of the decline, we will not get anywhere near the old highs anytime soon, in my opinion. Even if we started to, you've got so much money trapped at the top that got in at those highs a month ago that when you get within an eyelash, you get anywhere near them and people are going to want to sell. So I think we've got a slow, dull ache coming for quite a while. The comparison I've wanted to make here is actually twofold. If you guys, I'll try and make this quick. I go back to September 11, 2001, Joel, and before that happened, you already had that tech bust from 99 and 2000 that was working its way into a bear market. You had a recession that was already underway, and correctly so. Wall Street, the economic pundits and everybody was pointing at the Fed and how things had been managed in a speculative way and allowed to get out of hand, and a lot of fingers being pointed. And come September 11, that all stopped. The fingers were no longer pointed at the Fed or the powers that be. They were pointed at the terrorists. All right. And the Fed got off the hook. This time around, you had massive bubbles that had been built. Jerome Powell tried to be a responsible Fed chairman for a little under a year. Then he turned around, started rebuilding the Fed's balance sheet, cut interest rates last year, supposedly for insurance. Of course, he never took the insurance back. And now we're at a place that he insisted he would never take us, but did, to where the markets got so bubbly that they are now magnifying the effect to the downside as they deleverage of a significant economic hit that we're going to have. So likewise now, because the coronavirus is now the bogeyman, and we don't have to blame the Fed for getting us into this mess in the first place, now they've got carte blanche to do everything that they knew that they were facing someday to have to do anyway to keep things from completely taking us back into the Stone Age, and they're going to do it. So you've got the Fed now is going to backstop the commercial paper market. They're going to backstop municipal debt. They're going to backstop corporate debt. The shale part of that will be a fight between Congress and the Fed, but one or the other will do something, probably the Fed in that case. Everybody's talking about Boeing. Are the airlines going to get a lifeline? Yes, they will. And by the time all is said and done, Joel, if you were playing cards the other night and your buddy Charlie went all in on a hand and blew it, and he lost and he wrote you out an IOU, give that to Jerome Powell at the discount window at the Fed. He'll monetize that too. That's where we're going to go. So unlike what happened in 2008, the biggest comparison I would make between now and then is that they were really slow out of the gate then. This time around, they're just going to go nuts. I mean, forget $1,000 for every adult. The headline I saw, I didn't even read the whole thing yet, $500 a kid for a check that the government wants to send out too. They're going to do that. They're going to bail out this and that and everything else. Look, for a while, all of that is only going to mitigate some of the deflation that's already occurred and will continue to occur as the economic effects of this are felt, which is going to be a long process.
All right. So Chris, that's a bad scenario. That's a bad scenario. Paint us a more bullish scenario if you can. What would be
I'll tell you the takeaway bullish scenario for me, Spencer. The very worst long stretch of time to buy stocks ever was in a depression, right? From September of 1929 until April of 1932, the Dow Jones average, which was the big marker in those days, dropped by 89%. Yet at that same time, 1/3 of all publicly traded companies went up in value, because there's still going to be good companies out there with good fundamentals, good finances. The same, I believe, is true today. And even if we had that bad a scenario, and I'm not predicting an 89% drop, so don't worry, folks. The Fed probably is going to save us before we get to that place. But I think that there's going to be both trading opportunities and long investing opportunities in good companies. But we have to understand that things have changed, and that we're going to be looking passive. I mean, part of that, what I just said, the whole passive investing craze just took a mortal blow. I mean, when you look at what happened to those leveraged ETFs of the gold miners and how they annihilated the entire sector, consider the same thing was beginning to happen to treasuries. the same threat is there if we had a really disorderly decline in the stock market, which, and another good thing I can say, at least for right now, is that the stock market losing a third in a month, you really had no illiquidity, you had no systemic issues to speak of at all, like we did from time to time in past instances. Certainly, Joel, in '87, when everything seized up and everything was no bid for a little while, as you remember.
So I guess that answers my next question, which was, in light of this bearish picture you just painted for us, would you still come in and buy stocks like Advent? But I guess you said you would.
I just told people to do it today. And I'll give you another one. Look up ConMed. ConMed's a great medical supply company.
What's the ticker on that?
CNMD.
CNMD. Okay, I don't know it.
The other one that I added to my list today. I was in that stock years ago. Haven't been in it for a while. In my opinion, it was 115 bucks a share. It was overpriced. The stock was cut by more than half as of this morning, and it's just too cheap. It's a good, solid company. We need medical supplies and medical devices. It's all bread and butter stuff, nothing too outlandish. They're just a good, well-run. It started as a family company in upstate New York. So, you know, you got to ask yourself, what are we still going to need? What are we still going to use? People still need groceries. That's why Kroger went up. And in fact, the Kroger bought a few years back one of my favorite story stocks of times past, VitaCost, that helped jump them more into doing the internet online shopping and stuff like that. So, you know, there's going to be companies here and there. Broadly, as far as the markets, I think you're going to see, once we get to a place where the numbers are starting to go in the right direction as far as this coronavirus and almost whatever else is happening, you combine that with the policy response that's coming, I see at some point we're going to have a monstrous rip for people that like to trade.
Yeah.
You know, we'll recover half or 2/3 of the decline from the top, but you'll have to fade that, because that's when the next phase of the secular bear will start. It will be less dramatic, but it'll be grinding. It'll disappoint people who think we're back to the good old days. Just close your eyes and buy the spiders or the fangs or the triple Qs, and you know that's done. That's done.
All right, Joel, 350.
I'm sorry,
Joel, 357 here. What's going on out there in the market? The past few days, we've seen some rips.
Yeah, we're not seeing a rip today. We did see a dip. We tried to rally here, but right now we're just dancing right around unclosed on the session. I told y'all, you know, if we could just get a better close today, I would be happier to close anywhere near this number. We're currently trading down 2 handles here. Our close was 175 from yesterday. We're dancing right around 2,400. So didn't get that end of the day rip, or at least here we got 2 minutes left in the session. So it looks like for the most part, pretty much unchanged. We still got that double bottom. We couldn't clear that pre-market high. Made several attempts at it, but right now, I mean, who knows? Anything can happen here in the last couple minutes. But it looks like we're going to be unchanged on the session, Spencer, just down just a little bit.
Yesterday we said that it felt like a moral victory, right? How does today feel?
Today, kind of, yeah, I kind of feel that way too. First things first, I'll give you my opinion. I'll let Chris go. We didn't take out that low from yesterday, so it's still a potential double bottom in place. And, you know, the ranges came down a little bit. So, you know, that was good as too. So the vol has come down. The intraday range was tomorrow. So I still call the win. What do you say, Chris?
I couldn't see above, I guess. I completely agree. You know, it's good to see something without 4 digits at the close for the Dow. So yes, things are settling down. People are settling down. And yes, a moral victory is a great term for that.
Yeah. All right. We are heading into it right now. Just a couple, less than a minute away from the close, and what has actually been, as they said, a relatively calm day compared to what we've seen the past couple of days. Chris, I just want to ask you one question we had from the chat. Do you think the dividend aristocrats are going to hold up here?
Oh God, that's too broad a question, Spencer. Unfortunately, you look at it almost company by company.
Yeah,
I'll tell you, I've also in the last few days added back a couple of the pipelines. I was early in doing it. I probably shouldn't have done it. Might have to sell them on a bounce. Everybody's going to cut their dividend. You look at a Kinder Morgan, which is just a Cadillac of a company. And, 2/3 of their income is take or pay business. The whole theme about these pipeline companies being toll roads and that kind of thing, doesn't matter the underlying health of their customers and whatnot. But this is a case, especially where you've had babies thrown out with bathwater.
Yep.
And, whether they're going to hold up or not remains to be seen, because there is a potentially, if there's not some kind of bailout or backstop from the Fed of the junk bond market, and if some of these shale companies don't actually, frankly, get shut down to help push the price back up, there's way more misery to come. And hate to close on a sour note, but this is long term for markets. This is more devastating than the coronavirus if this doesn't get straightened out.
All right, S&P 500 closing at 2409.50. That's a 0.48% gain for the day. We like it, I guess.
Yeah,
Chris?
futures are
Yeah.
bouncing around pretty good here. So they got another 15 minutes to sell. We did have a quick dip there, but like, who knows? These things are going to be open for another 45 minutes. You can flip a coin and where it's going. So,
I mean, Joel, you're way more a technician than I am. Does the fact that we haven't had a close below that 2350 level from Christmas?
yes, yeah, we talked about that yesterday.
Yeah.
Yeah.
And as long as we don't close below that, we still got the fort held, right?
Yep, I agree. I agree. And if you want to give yourself a little bit more room, you can go down to those lows from Wednesday and Thursday at 2265, 2275. I mean, that's 150, 130 points of risk from here. But, the market has made these lows. It's had some wicked rebounds. And for now, holding those lows from today and yesterday, very, very important for the market. And, on the upside, the high from today should be a good barometer. No further upside until you can get through those today's high at 2460.
Yep, we want to see the number over my right shoulder increasing. Days since trading halts. We want to see that number increasing. That's a good sign. All right, I want to thank Chris Temple for joining us today. We will be back with you folks tomorrow morning. Everyone have a great rest of your day. And I guess as I've been saying, be safe out there. That's all there is to say.